Welcome back, everyone. In a recent video, the Reset 2025 one, I mentioned that I haven't bought very many stocks over the past few years. And today, what I'm going to go into is the ones that I did. And the ones that I did outside of the public portfolio that you've already seen. And some of them probably not what you think. Well, at least based on before. As always, you know, this is not investment advice, but I also want to say, in addition to the general don't copy me on this one, is that a lot of the valuations on these have changed over time. So it's not necessarily the same uh, investment outlook now as when I was buying them. Some might still be good buys, others might not. Some have increased in valuation. But I just wanted to say that, but not that you were going to copy me anyway, because this isn't investment advice. And as I was saying, there's not that many. There's realistically, once you remove the ones of lower quality or the ones that I, I might buy like a few shares to watch and then never really establish a position. Once you eliminate those, there's really only five. And before I get into the names, I just want to talk about why the shift in philosophy. What were the problems with before? Because it was getting problematic. The problem is that effectively there was too much babysitting positions. Having capital in shorter term stocks was wearing and waiting on the fundamentals to change, having to check up on management that were not necessarily achieving what they set out to be, or having to wait and look for an exit based on ever-changing fundamentals and evolving markets. It's more work than sometimes than the upside that it provides. And so I wanted to have more of the capital in a more pleasant form of investing, and one that works. So hopefully. So I shifted, or I've been adding more capital to places where there's less babysitting and more quality of the business, where I'm convinced that every day the business becomes more valuable. Basically, I want to be able to make money, have investments add value, even when governments and central banks do their very best to screw up the economy or the world. So without any further ado, the first company, I should say, is Topicus.com. Now, Topicus is the first child, the first spin out of Constellation. And this is it's basically, in one of the accounts, it's the one I mentioned, where basically I bought one thing and there's not too much to say about it. They roll up software. They have tons of different verticals, and they every few months or however long it takes them to find something new, a small company to buy, they buy it, and they're just good at it, and they earn high return on investment on every purchase they make. And yes, I will be the first to tell you the multiple is much higher than what I would prefer to pay, but they work down that multiple by the day, so you're paying up initially, but they keep adding value. The valuation metric that I would look at for Topicus, because they're software, but also because they run through a lot of amortization in their purchase. When they buy something, there's intangibles, and that amortizes over time. So I would look at EV to EBITDA, and really with it and with the whole family of Constellation, if initially there was a big increase in valuation as it kind of proved itself out, but since then, the valuation hasn't really changed. I'll get to that in a second, but the valuation is kind of high, but staying high. So realistically, what matters is the growth just goes down to the bottom line. So like, let's say they grow 15%, the stock will grow 15%. If they grow 20, the stock grows 20. Eventually, the valuation will need to come down. But when is that? I have no idea. And what I like about, I mean, the interesting thing about Topicus is that they have a little bit of organic growth, probably more than some of the other parts of Constellation. I don't actually ascribe any more value to the fact that they're smaller, because they're buying from the same pool as the rest of Constellation, so I don't think that makes them any more valuable. What might make them more valuable is A, the organic growth, and B, their willingness to use more leverage in when they're making acquisitions, so they can have more capital deployed at any given time. Now, the data isn't as good here, and it might be slightly hard to see depending. So I used Constellation for the bottom one to kind of illustrate my point about the multiple. It's a bit higher now, but realistically it's been in the 17 to 23-ish range for a long time, for a decade plus. And it's in there now. It's towards the top. Constellation, Topicus, the graph doesn't really work because of the shares outstanding and the currencies. I don't know why, but it doesn't. But the top one basically shows their revenue growth. And as I was saying before, assuming the flat valuation, what's going to matter is basically long-run revenue growth, because that will eventually transmit to the bottom line. The second stock is Dollarama. Dollarama is, I mean, many of you might know it. It's one of the biggest retailers in Canada. It's one of the biggest retailers in the world. I think it's top 20 or top 25. And it's a discount retailer, so a dollar store, or depending on what part of the world you're from. It's expanding in Latin America now. It's just bought something in Australia. So it's really starting to really break out of Canada. Canada, I'll be the first to admit, it's very highly penetrated. There's a lot of Dollaramas around, and I don't really necessarily see that much more growth. Although, they're adding one not far away, so it just keeps growing. But what I really like is they earn high returns on invested capital, and each store they make pays back in about 2 years, which is great. And the more stores means more money. Now, Dollarama is a retailer, which means that their growth actually can require, if you could still use that word, negative working capital, because of the payment cycle. Basically, they get goods and can sell them before they have to pay for them. So more growth is negative working capital. Now that's a big benefit for retailers, and something that rarely gets discussed. And so in addition to Dollarama's international growth, the way that they have really been able to provide value for a long time in Canada is by yes, very good return on capital and growth, but B, shareholder returns, and really profiting from being able to grow on multiple levels at once. For instance, they get the organic growth from same-store sales, plus they get sales expansion growth, plus they get a few percent here and there from share buybacks, because they don't need the capital to grow. Now, how I found out about Dollarama is how I grew to like it as an investment, I should say, is really from a story from a colleague. He was talking about how he really loved it back in 2009 when it first went public. Now, unfortunately for him, he trades a bit more than would be ideal, so he's been in and out a number of times, but he's also gotten a 20-bagger over his life in this company. And one of his points was, when people find a discount retailer that they really like, they find the value, and they like it, and they go back. And so while they may be pushed to such a retailer in tougher times with the trade down and that type of thing, over time, once you find something that offers you better value, you go back. And so it's really sticky from a value proposition, and he's also a bit cynical. And he said there's going to be more and more poor people over time, which may or may not be true, but there's always more people that appreciate value. So anyway, that was kind of what got me thinking about Dollarama as an idea, and I really liked it. The valuation metric, on the other hand, when I looked at Dollarama, it seems like something that should probably be trading in the high teens in EV to EBITDA. Recently, that really expanded. That is probably partially because they're expanding into new markets, Australia, and there's a lot of theoretically built-in growth there, where as they convert the stores, they can grow and earn higher return on invested capital on those stores, also grow in Central and South America, and they're expanding into Mexico, and so there's a lot of growth that they're just budging into. And on the bottom, the chart is the total return chart, because there's been, I would normally go to revenue growth if it was, if they weren't buying back shares, but they have been, and so you really need a picture of the total return, and it's really been mostly pretty steady in the low 20s%. And yeah, I would caution on the valuation very short term, but it has been a very impressive company. Next is EQ Bank. And this being a bank, there's a limited amount of excitement that I can draw from it. I think EQ is an example of how simplicity can just kind of work. It's a bank, which means that basically I would look at it as the amount of equity it has times what's return on equity that it should be able to get, and that's what it will earn. And so every day they earn a little bit more on equity from the spread of their business and lend out more of that and earn more money. Now, I know in much of the world people really don't like banking, and there's probably, there's at times there's reasons for that, but at other times there isn't. Banking has been around for a long time, and it faced a lot of challenges in the prior decade. But in some regions, Canada being one of them, the banking system is different from what it is in the U.S. Now, that's not saying it's not a risky business. I'm just saying that the structure and the risk isn't necessarily, and the competition isn't necessarily the same as the U.S., for instance, because there's a lot of regulation, and so in some areas where people are willing to put up with all the regulatory headaches, it might not be as bad a business as some are expecting. And EQ Bank has basically been earning mid to high teens return on equity for a very long time. And that kind of puts a way of looking at it that made sense to me in terms of book times return on equity, and that's how much it's going to grow. And from that, you could use what it's going to retain and figure out how much the value is going to add. And when I look at it, as I said, high teens return on equity, trades book to book and a half most of the time. That means it trades at 10 to 7, 8 times earnings most of the time, and it will grow maybe 12 to 13%. It'll pay out maybe a 2% dividend, and that's kind of a very balanced and effective way to grow a company. Now, it's not going to make you rich, or make me rich, I guess, but it is decent returns, and it's decently efficient, and it does return capital, and it does grow at a decent clip. And that's really what it's all about. The next stock is MDA Space. Now, MDA is a, surprise, surprise, space company. Now, they make satellites, they do Earth observation, space robotics. Like, I don't know if you've heard of the Canadarm. Well, their predecessor made the Canadarm, and they have geointelligence and space Earth observation, and they have a number of businesses. Now, the one that's the most interesting to me is their satellite business, and where they have a leading edge digital satellite. Basically, satellites, conventional satellites have like two beams that kind of point one direction and another direction, and that's where they cover. And the digital satellites basically have reprogrammable beams and a whole lot more of them, so they can kind of direct to more useful places. And this has given them a nice edge in recent years. And yes, they'll have to keep investing to keep the lead, but it has led to some rapid growth in contracts, and they are currently expanding a facility to hope to grow even further. Now, in recent years, their revenue growth has been 25 to 35, 40, 50%. It always bounces around, and it's not steady because of the way the contracts are. But it has been a bit of a interesting company because they've put up that revenue growth while managing to stay at kind of a reasonable valuation in some, through the right lens. The valuation that I would use for MDA Space is something like EV to EBITDA, because it is kind of a services business, and there is a lot of the depreciation, amortization kind of expenses to write off for growth. And I mean, you could use price to earnings if you want. I mean, you could use anything if you want. But as long as they keep up with the backlog, EV to EBITDA is probably the way I would look at it, because it would be capital light. Now, they do need to keep finding new contracts, keep growing the contract book. As always, it's just here with the contract book being shown, it's kind of probably more in focus than other places where it isn't. And here are a few of the metrics that I like to look at from MDA Space. Bottom is EV to EBITDA. As I said, it seems like a pretty reasonable valuation, 10 times forward EBITDA for that type of growth, and the top being that type of growth. That's the trailing 12-month growth rate for revenue. And you know, this is a business that where the EBITDA, their earnings, whatever you want to look at it, a lot of it can be free cash flow, but it hasn't been. It hasn't been free cash flow because they have been spending so much of it on their expansion. But once their capacity goes from one satellite a week to 2 a day, that's a lot more capacity. And once they have that capacity, there's a lot of room to grow into. So that could be, that would open up a lot of free cash flow, unless they find other stuff to invest. And when they're earning this much returns on their investments, I hope they do find more stuff to invest and stick at zero free cash flow for a very long time to come. Number 1, or number 5, depending on how you look at it, is 3i Group. Now, this is the only stock, this is the second stock in the list that's not based in Canada, and the first that's not listed in Canada. 3i Group is action. I don't mean that in that it's exciting. I just mean that in they are a private equity holding portfolio, and one of their holdings has kind of got to a size that dominates the portfolio. It's something like 70% of the portfolio is one investment, because it was, to date, more than 100 bagger. And that investment is Action. Action is a retailer in Europe, a very effective discount retailer that has been growing 20 plus% for many years now via, like Dollarama, the multiple chains or multiple legs of growth. There's the store count, which is growing depending on the year, 10, 12%. There's the same store sales or like for like that can grow 7, 8% or can grow much more than that when there's inflation, which has benefited them for a few years in the past. But even last year, where there was deflation in some goods, they basically were still growing nearly 10% in the same store sales growth. And you put that together and you add in the fact that the payback for the stores is a fraction of what it takes Dollarama. So the payback is, I forget if it's 2 or 3 quarters for a new Action store. Very quick. And it plus the negative working capital, plus the ability that when they grow, they're able to return more capital to shareholders by relevering up. And you really have this capital negative growth where the more they grow, the more capital they have to return to shareholders, which when they've given to Action has been using it to increase their stake by buying out other shareholders, or just have more capital for other investments. Now, 3i has been in this for more than a decade now, and it has been one of their great investments. I would bet that there's some other decent investments within the portfolio, and I would love to go into detail and talk about all of them, but I don't honestly have much of an opinion on most of them, and partially because I don't really know them that well. The other thing is a lot of them are very small. I think there's some other interesting ones, but it really depends on what you're looking for. And I think Action is very interesting because although it's had tons of success in Europe, and there's still, if you look at the density that Dollarama has in Canada compared to the density that Action has in Europe, there's still a lot of possibility for densification, if you will, in Europe. Plus, they haven't even entered markets outside of Europe. So it's really an interesting one, I think. But on the other hand, valuing it is tricky because Action is marked at a specific multiple within the book. It's, I think, 18.5 times EV to EBITDA, which I would love to own more Action at 18.5 times EV to EBITDA, but it's a private market and it's hard to access. So you really have to look at what do you think Action is really worth and market there yourself, and then kind of look at growth. So it's valuing it is tricky because there's a lot of moving parts. And so in the end, what I kind of look at is something like 1.7 times book. Now, this is a decent move away from what it traded at a few years ago, which was something in the range of 1.25 to 1.5 times book. And so maybe the market is finally noticing that the growth from Action and the fact that it's making up a larger and larger part of the portfolio, so its growth is going to attribute more and more. And if it can grow at high teens % plus returning capital, that could be low 20s%, or depending on if they're able to buy more, or how much growth, how much capital returned, and how they do it. It could be some pretty good returns. And what I have in the top there is basically the historical return on equity from 3i Group. And as you can see, this is why I wouldn't use price to earnings for something like this, but it would be, even at their higher end of the valuation, it would still be single digit price to earnings on most years what they earn. And now that's it for the stocks. Now, obviously, I don't make these purchases that often. It's been a number of years, and there's 5 stocks here, so it's like 1 or 2 per year. Um, so they don't happen often, but if I do make more purchases of this type of company, I may mention them on this channel. So I say that because I don't want people thinking that I'm only going to be doing dividend stuff, although that is where most of the action happens. So with that, I want to thank everyone for watching, and as always, I invite any comments on any of the stocks I mentioned or anything else. Have a great day.